Welcome all of you to this webinar. Don't worry about being late for 18 minutes. The idea is to give you enough content for coming 2 hours so that you get the full value of the knowledge which Kunal has to offer. Okay, so I'm very thrilled to welcome Kunal Saraugi with me. He's right here with us, and I'm very excited to invite him to share his experience and knowledge about the market. Kunal.
Thank you so much, Vivek, and thank you all of you for joining. And sorry for the delay. And now we're finally all set. So we have all of the people who've joined us today. Thank you so much for joining at this hour. And today we will talk about a lot of things. And the topic that we've chosen for today is identifying large trends using technicals. So the idea here is that we will talk about uh, how to catch the bigger trends, that is the major ones. Trends are short-lived. These small trends are what creates a lot of noise and confusion among traders. But otherwise, trading very clear long-term trends that one could look at. So in this webinar, our focus will be on trying to capture those major trends. And of course, you will see the video in a short while. We're trying to get that going. But in the meantime, we're talking about how markets function and so on, and how you can capture the longer term trends. So I think the video should be visible now to everyone. If it is visible, you can just say yes, if you can see me. If you can see me, okay, wonderful. So now I'm visible. Great, great, great. Right. So thank you once again for joining, whatever time we've got. Of course, 2 hours is too short a time to explain a life-altering investing philosophy, and that is not my objective here. The objective is to get you started to in a direction, to get you to think and think about the possibilities there are. There's a lot of money to be made out there. Markets are huge. Of course, at this point in time, when there is this overbearing fear of the coronavirus, markets have come down, people are wary. The questions that we get all day long is whether one should exit one's portfolio, exit all the stocks one's got. People are now actually deliberating about stopping their SIPs and so on. So there's a lot of fear, and there's a lot of a bit of nervousness all around. So that is the atmosphere, that is the climate that we are in. But one should look at the longer term picture. This isn't the first time something like this has happened. This happens all the time. And those of us several such uh, situations in the past. So I will, in today's webinar, talk about my own experiences as a trader, the mistakes I have made, and that is the focus of today's webinar, is the mistakes that I have made as a trader. And I think that there is a lot of learning out there that has helped me the most. The learnings and how to actually uh, learn of your mistakes is what we will talk about today. But coming back to the situation that we are in, that is the coronavirus, let us first start off by looking at the chart for the Nifty. And so that we know where we stand. And so that, and if you can see the chart for the Nifty, can you see it now? Is the Nifty chart visible to you now? Okay, great, great, great. Finally, we have it going. And wonderful. Thank you so much for your cooperation. And this here is the chart for the Nifty. And this, of course, is 2003 and 2004. Three and four. Now, the first point that I'm trying to make is that there is a thing called mega trend. Now, mega trends can last for several years, and there is a mega trend on the Nifty. And that trend, as you can very clearly see on this chart, has been positive. And that's the reason why all mutual funds have delivered such returns. That's the reason we are sitting here today talking about the markets, is because our markets have done so wonderfully well in the last 15 years. And all of this started right here at where the crosshairs are. And this is 2003, when the market for the first time broke above 2000 levels. And this was after the disaster of 2000. 2000 is when a lot of people lost a lot of money on the markets. This was the Ketan Parekh era. And then in 2003, markets were able to put all of that behind. and then move on. So this happened in 2003 and 4. Markets went up, and then a trend started off right here. So what I'll try and talk about today is that from in all of these 15 years, there are a lot of mistakes I've done. In fact, I tend to believe that probably I am a living legend in that I've made more mistakes than anybody I know. So all of these mistakes, of course, cost me some money. A bit of confidence wears off every time you lose money. But what it brings to you is wisdom. And I like to imagine that all of these mistakes I've made over the years has brought me some wisdom. And I'm trying to help you understand what each mistake that I made told me so that you can sidestep those mistakes so that you don't fall into those same traps that I fell into unknowingly, unwittingly back in my day. So this is the objective of today's webinar, is to try and tell you how to get around those problems. Of course, you will see those problems and you will know what to do when you actually encounter them. So this is 2003, market started going up, and then there was this huge uptrend. There is a series of higher bottoms on the chart. So first thing first is that what defines an uptrend? Markets are in different stages at different points in time. One of the trick to long-term investing is to identify what is the current trend on your stock. What stage of the market are we in? So back in 2002 and 3, if you were looking at the chart around here, this is 2001 and 2, you would see that the markets were largely sideways. So let's call this part of the market sideways. And then uh, post 2003 up until to date, you see the markets in a different trajectory altogether. So see two sides of the market on this chart. You see a side of the market that lasted till 2003, and you see a very different market from 2003 onwards. So from 2003 onwards, markets went into this uptrend. And this is something that we should now focus on. Now, the reason I'm telling you all of this is that this is the same thing that we're going to relate to stocks. You have to identify what stage is your stock in. Is it in a stage where it's consolidating? Is it in a stage where it's expanding or rising? Or is it in a stage where it's stalling? Or is it in a stage where it is declining? So if you look at the markets or any stock for that matter, it typically has got four different conditions that your stock could be in. There can be an extended long period of consolidation, and that is one of the most difficult market situations to deal with. No money ever gets made in a consolidation, and that is something that an investor needs to sidestep. So we'll talk about that, how to identify and deal with consolidations. We will talk about how to consciously identify stocks that that have got a trend, and then we will look for stocks that are stalling, and then stocks which are declining. So once you can make the difference between all of these four different conditions, it will make your life a whole lot easier. It will improve your stock selection, and that is all that there is to it. Superior stock selection. Timing, of course, is something that we are obsessed with, all of us, and we have 100 different indicators which help you time better. But in my own experience, more than timing, what matters is stock selection. That is what uh, differentiates boys from men, as they say. So we'll talk about how to select stocks more effectively. But first thing is to identify the two different shades on this chart. So there is a big data that you see, the first part of the data, which tells you that the markets are in consolidation. Now, of course, you can see on the charts that this consolidation lasted for more than a decade. And but more than a decade is too long a period. Now, if you go back in history, this was a very volatile time in the markets. People lost a lot of money, made a lot of money. So this is difficult. But you must try and understand that overall markets were essentially in a range. It is after 2003 that they picked up a trend. And once you understand that the trend is on, all you have to do is to get in to that trend with a longer term horizon and continue holding that stock as long, or that index for that matter, as long as it continues to form higher bottoms on the chart, which is one of the most rudimentary ideas in technicals, but works wonders. Now, I have been encountering this problem in my trading in my journey as a trader, as an investor, as a trainer for the last so many years, that we all have this fascination for complex ideas. Now, there are a lot of fads in technicals. I remember long years ago, I spent a lot of time trying to understand what Gann analysis was all about. Then I'm sure a lot of you must have heard about Hikenashi and Renko charts, and so much is going on. Of course, they have their place in the world. But if you look at the charts from very simple, very basic standpoint, it still makes a lot of sense. In fact, it sometimes makes a great deal more sense if you're looking at it from first principles. And that is what we are trying to do here. We are trying to capture these longer term trends. Now, when I first started trading, I tried everything in the book, like most of you would. I started off and I traded intraday, I traded long term, I traded options, I bought them, I sold them, I hedged them, I did delta hedging, I did everything under the sun. But it's only with a lot of trial and error that you understand that these are the ideas that you can implement well. I realized very early on that one concept that has made a lot of money for a lot of people world over is investing. That is, investing for slightly longer term. And that is what I have been consciously doing for my own investments. My own investments have done wonders for me. I think it's a wonderful way to trade the market, longer term investing. So that is something that has given me most of my returns. So we'll talk about that, and that is one area, one thing that I do. And today, of course, we're trying to focus on that. But apart from this, just for your knowledge, I also do a long short um, fund. That is something that I've been running for a long time, where we sell stocks which are underperforming and buy stocks which are outperforming. And I also trade Bank Nifty on a shorter duration time frame. But today the focus is the first idea that came to me and the idea that has delivered me the maximum returns, which is investing for medium to long term using technicals. Now, one thing, there's a big thought, and there is this feeling that a lot of traders have, that investing works well with fundamental analysis. That is the best way to approach a investing situation. So if you're an investor, you would do better if you used fundamentals as opposed to technical analysis, which is something that most of us feel is mostly for trading. Now, although this idea could be partially correct, it's because there is nothing in fundamentals that could help you with with short-term trading, and therefore technicals is the only thing that can help you in short-term trading. But technicals also works very effectively for medium to long-term investing, and that is what we will talk about today: how to use longer term, how to trade for the long term using technical analysis. So
Just I wanted to cross check with you people. Are you able to hear? Just wanted to check once again if everything is fine. Are you able to hear? Oh, fantastic. Thanks a lot. Aniket, I guess there is some problem with your system. You just have a look at it. So I'll keep on coming in the middle and check whether
yeah,
people
it's
are.
better to be safe than to
Yeah,
be sorry, is
yeah.
because I will go on and you won't get to hear. So if you are having some trouble, just try and check your internet.
Yeah.
Your internet could be as bad as ours. So that is the reason. So we are talking about the markets. And so the first point that I'd like to make here is that markets, or all stocks for that matter, work in different segments. It is important to identify what stage your stock or your index is in, and then identify stocks accordingly. So we'll talk about how that works. So I was talking to you about uh, what happened here. In this particular situation, this is 2003 and 4, markets broke above this consolidation. Now just try and put yourself here. Just imagine you are in November of 2003. You've had a disastrous couple of years in the market. People have lost a lot of money in IT stocks. This was the time when there was a thing called TMT, which is telecom and media and technology, and the entire world was completely enamored of these stocks. And then there was this dot-com bust in world over, and a lot of Indian companies suffered as a result. We had these stocks called Silverline and Pentamedia. I'm sure most of you must not have even heard of these stocks, but back in the day, they were big names, and they completely vanished in thin air, and this was the breakout. Now, if you're placed here, you would be very scared of the markets because you've just underwent this huge collapse. And now the markets are beginning to recover. Not only recover, they're now breaking above their previous highs. So this is the point when you know a consolidation just got over. This is the time to buy. But unfortunately, most investors here would be so scared of the markets because they've just been through these very difficult situations in the market. They've lost a lot of money. And as a result, they don't really trust the market. So this is the phase generally referred to as denial. Denial is the place to get in. So first thing that you must know is that it's absolutely critical to enter at the right time. A lot of people, for instance, there are people who've bought a stock called IRCTC. I've been inundated with queries on that stock. That stock has done very, very well over the last few weeks, and it's been running away. And people bought at the top, and that happens all the time. You buy at the top once there is a lot of euphoria, and that is where people get in. So the first thing that you must know is that you may be a great stock picker, but you have to enter at the right time. So entry is important. Second most important thing is that once you've entered, sometimes people enter at the right moment out of happenstance or just because they got it right, or even after a lot of analysis, they get their entry right. Getting the entry right is not too difficult. What is most difficult is to get your exit right. So how does one exit in time? That's the second major question that an investor has to deal with. So if you look at the number of questions that you need to find answers to, the first question is what stock to buy? That is the stock selection question. Second question is, are the markets supportive? This is the second thing that you must, and you might want to note this down. The first thing is you have to pick the right stock, which is very, very critical. There are 6,000 listed stocks in India, and it's difficult to identify those handful of stocks that will deliver outsized returns. So how does one choose those stocks? That is number one. Second thing is, how does the market seem? Because see, if the markets go down, everything goes down in its wake. So no matter how good your stock is, if the markets are collapsing, your stock also will go down with it. So that is the second question that you have to find an answer to, is how are the markets placed? Third question is, after you've selected the stocks, you're sure about the markets. The third thing is holding on to the stock, identifying whether the stock merits to be held on to or should you book profit. That is the question of exit. So this is very critical, and this is where most people get it wrong. A lot of people get it right when it comes to entry, which is fairly easy. The toughest part is when to exit. So you must have clearly defined rules to help you exit in time. And the fourth part is how much to bet on each stock. That is position sizing. Is because we've got limited capital. No matter how big your capital is, you still have just a little bit of it. So how do you apportion your capital across these stocks that you like is the fourth important decision point that a trader needs to find an answer to. So 4 points here. First is stock selection. Second is getting your entry right. Third is getting your exit right. And the fourth part is risk management. How much money do you put into each of these stocks? So, and of course, the index. You have to look at the markets also. So in 2003, we saw this big breakout on the index. Now, if you were an investor before that, you wouldn't have made too much money. You would have made money on individual stocks, but finding those outperforming stocks becomes a challenge. The real money gets made when there's a mad rally in the markets itself. So as an investor, you would do well to look at the markets also while investing. You may not want to look at the markets while trading, but you will have to, per force, look at the markets while you're investing. It's because most stocks are very heavily correlated with the Nifty. If the Nifty goes up, everything goes up. And if the Nifty goes down, you would have to be a very, very astute stock picker to be able to identify those couple of stocks that are doing well in a falling market. So my sense is that the first thing that you need to focus on is whether the Nifty is supportive to investing or not. Luckily for us, there has been this glorious 14-year uptrend and 16-year uptrend. And we have not had a single lower bottom in the last 16 years. If you talk about the major ones, we haven't seen a single major lower bottom. And the Dow theory principles tell you that the Nifty is in a long-term uptrend. And if that continues, there will be more opportunities in investing. But if that changes, then everything changes. For instance, and now a lot of you who've entered the markets later than I did would think that that never happens. It's because you've never seen it happen. But it can well happen. So one thing that you must remember is don't take the markets for granted. And if that thought ever comes to you, or if you start believing it too seriously, all you have to do is to pull up the chart for the Nikkei 225. Just like we have the Nifty in India, we have the Nikkei 225 in Japan. That's the Japanese market index. So let's see if we can get that chart. This is the Nikkei 225. And Nikkei 225 started its journey in the 1980s. Now, once this fills up, you will see the data from the past. And in 1980, I think it was at 4,000 or something, or probably even lower. I don't remember the level where it started. But in 1993, it made a top of 40,000. And this was the time when Japan ruled the world. This was when Japanese markets and Japanese companies like Mazda, Nissan, and so on were the biggest names, and they were acquiring American businesses, and a lot of things were happening back in that time. And Japanese management practices were being adopted by companies the world over. This was the 1980s. And in 1990s, Japanese market started coming off because there was such a big bubble there. Prices had gone up too much. A lot of people made huge money. Every fund was in Japan, and they were investing heavily in Japan, and they were calling Japan the biggest economic superpower. And in 90s, it all started unraveling. And then you had this huge collapse that went on for several years. But look at the extent of this damage. Of course, we're not talking about macros here. We're not talking about long-term charts. My idea is to tell you how to pick stocks for your own investing. But just to give you a historical context, one point that I'm trying to make is that you must be conscious of the Nifty. If the Nifty is in a long-term uptrend, it's only then that investing will work. If the Nifty is in a long-term downtrend, then no matter how good a stock picker you are, you won't be very successful. Now, what happened in 91? 91, the markets, the Japanese markets were at 40,000. In 2003, that is how many years? About 13 years later, they were at 7,000. So that is an 80% decline, more than that from the top. Now, if the index were to correct 80%, imagine what would have happened to stocks. Stocks would have been completely decimated. So no matter how good you are with stocks, no matter how strong your technical system, your strategy, your fundamentals are, you just can't make money in a market like that. So one thing that has to be there, that has to be very important for you, is that you must keep the Nifty chart right before you in your line of sight always while making investing decisions. So this is the first rule here, that you must look at the index first. If the index isn't working, nothing else will, no matter how good you are. So this is one major takeaway from this webinar, that you must know how the Nifty does. And it's not too difficult. Now, a lot of people say, what indicator would you use to see how the Nifty is doing or when it's changing course? It's not very difficult. One look at the chart and you would know. For instance, you don't have to be a technical analyst to know that Japanese market started correcting in 91, and the charts completely reversed from there. So even if you get to know this slightly later, it's still okay. Even if you didn't exit at 40,000, you exited at 35,000, you still saved some money to be able to buy again. But if you didn't exit, a lot of people didn't exit. There were patriotic reasons for why people don't exit. Then they're completely lulled into some kind of complacency that long term mein sab kuch badh jata hai. So this is the general belief system we are so deeply drilled with, that it is long-term investing is always safe. In fact, there is this very interesting book that is written by a person called Jeremy Segal. Now, in case you ever get time to read, I'm sure a lot of you are readers here, you would want to read the book. It's called Stocks for the Long Run. The author is Jeremy Segal. Read that book and you'd get to know one of the that long-term investing can be very, very risky. Even if you invested in something as safe as Dow 30, you would find that a lot of money got destroyed trading in uh, Dow 30 because its components keep changing. So those same companies that were part of Dow 30 20 years ago are nowhere in existence now. So the point here is that long-term investing has got its own risks. And those risks are something that a long-term investor must always be conscious of. So first point that we're making here is that you have to be conscious of the Nifty first. So if this is something that you're all okay with, just say yes here so that we know that you've been able to hear me well and that this is a point that you understand. Just say yes here so that we know आपको
Yeah.
समझ आए.
So, repeat the name of the book. So, what's the name of the book?
It's called Stocks for the Long Run.
Stocks for the Long Run.
Right. And the author is Jeremy Segal.
Jeremy
Segal. S-E-G. Just Google the name and you will get it. Okay. So wonderful. All of you have been able to understand and follow us, which is great. So now the second point here is that after you've seen the Nifty and you're comfortable with the Nifty, the second thing you need to do is to identify the stocks, how to enter at the right time. So you have to identify stocks which have had very serious consolidations. So one of the stocks that I bought in 2010 was Hindustan Unilever. Let's try and see the chart. I'm sure, I'm not too sure if some of you would have it. So it's because the price has run up too much in too little time for a stock of this size. This is Hindustan Unilever, and the year was 2010. It was in this huge consolidation. Hindustan Unilever had not seen levels above 300 ever since it got listed. So this was the first time in 2010 that it finally broke above 315 levels, which was a major resistance. Now, Hindustan Unilever is not a small company. It is a company that's on every analyst's radar. It is a part of most HNI portfolios. It was back in that time. And I had a lot of people who had very significant holding in HUL, and they swore by the company and they said it was a tremendous stock. But they thought 300 was too high a price. It's because they had seen prices much lower. And HUL had this tendency of coming to 300 and then going back down again, and then coming back to 300 and then going down again. So this time when it was at 300 and it broke above that level, technically we call it a breakout. That's when we buy. But most investors thought that this was too high a price. And the question they had was, why would HUL go up that much? What could possibly happen? What good could possibly happen to HUL that would cause the prices to go up that much? After all, it's not a technology company that would suddenly come up with some new technology that would revolutionize the world. It was, after all, at the end of the day, an FMCG company and boring at that. So how could HUL suddenly get that kind of valuation? The stock started going up and investors started going out. So a lot of people, now just put yourself again in this particular time spot. Just imagine you had shares in HUL, the price had broken above 300. You've been holding for several years now, and it's only after 5 or 6 years that you've been able to see that 300 price tag on your stock. Now, your instinct would be to try and exit first, is because last time you saw 300, the price went to about 200. So you don't want to wait any longer. You'd exit at 315, 320, 330. As the price went up, retail investors came out of the stock. HNI started coming out slightly later, but all of them exited en masse. And the big question is, where did all the stock go? If everybody was selling, who was buying? It was a handful of investors who were buying here when everybody else was selling. And these handful of investors knew what would happen to HUL going forward. And this is the place to enter. This is when everybody exits. There's a big breakout on the chart. You're completely comfortable with the markets. Now, in 2010, if you remember, the markets after this collapse of 2008 and 9 had begun to go up. Markets made a bottom in 2009 at around 2,500 after the Satyam confession, and they started going up. So in 2010, the markets were good. This stock was breaking out, and this was the place where you should have entered HUL. Now, the question is, if you had met me in 2010, and if you had asked me, what could be the potential target for HUL? I probably not in my wildest of dreams would have imagined that HUL would someday go to 2100 rupees. Not someday, in the next 10 years. I would have told you that it would take HUL at least a lifetime or maybe 30, 40 years to get to those levels. But it happened very quickly. It started going up. And this was not expected, but it was happening and it was so good. All you had to do was to invest at the right time and stay put. Now, if you use basic technical analysis here, you'd find that each bottom that we have seen post 2010 has been higher than the previous. As long as you get these higher bottoms, the stock is in an uptrend. HUL continues to be into this glorious uptrend, and it's now at 2100 rupees. It's gone from 310 rupees in 2010 to 2100 rupees in 2020. And this is something that I'm sure nobody could have believed if you had told them that this is how it would pan out in 2010. So one of the things is that we are not predictors. I couldn't predict that this would go to this level. All I could do was in 2010, I knew that this is a stock one should buy. I didn't know it would go to 2100 or 1500 or 1200 or 600. I didn't know that. If it had gone to just 650 in 10 years, I would still be happy with my investment. But it turned out that the stock went to 2100 and it's outperformed most mid-cap stocks. Even a mid-cap stock wouldn't see such a rise. So the point I'm trying to make is that you won't know this in advance. A question that I get to often, all the time virtually, is that what is the next major HUL or what is the next Honeywell Automation or what is the next 3M India? See, it's very hard to actually know this in advance. When I bought Honeywell, and Honeywell at the time was trading at about 2000 rupees, I had absolutely no clue what could be the target. In fact, the stock wasn't doing too well when I bought it. And I'll show you the chart now for Honeywell. It's a multinational company and it's listed in India. It's a tremendous company, great stock to own. And I bought it around here in 2014. The stock was trading at around 2000 rupees. Right here. And this is the region, this is the place where I bought it. And the stock wasn't doing too well for a very long time. There was this extended period of consolidation. And then just when it was taking off, that's when I got in. Now, once I got into the stock, now the thing is, you could buy at the right time. Look at the price for a moment. I keep looking at the price for Honeywell Automation, and it keeps giving me a very warm feeling. It is now at 35,000 rupees a share. From 2,000, it's gone to 35,000. Imagine. And if you had asked me again the same question in 2013, that should one buy HUL, would it go to 30,000 or to 20,000? Now, these are very tough questions that nobody's got a very definite answer to. We all hope that it does, but we don't really know where it's going to land up. So the idea is that you buy the right thing, hold on to it as long as the chart tells you to hold on to it, and you exit the moment the stocks turns sour or starts to deteriorate. That's when you must exit. So the third major point here is exiting at the right time. This, of course, hasn't really given me a chance to exit. I bought it at 2000. There's not a single lower bottom on this chart, as you can see. No rationale at all to exit. But a lot of people did exit, of course, is because one of the most difficult things in the world to do is to withstand profits. So once you get profits and you get more than you expect, it is difficult to resist profits. And that is the toughest thing in investing. You have to be very patient with your profits. Not an easy thing, but of course, right. So we'll talk about BHEL also. Somebody wants, or maybe they have a position now, which is exactly the opposite of this chart. So we have this wonderful chart for Honeywell Automation. Let's see if we can get the chart for BHEL. Okay, so BHEL also back in its own day. Now, if you look at that huge consolidation, that is 2002 and 3, then it went into this glorious uptrend. It lasted for several years. In 2008 and 9, it made a top, and then it stalled for a bit and started coming down. Now it's back at 30 rupees, right where it started. And the trick here is that, of course, even in a stock like BHEL, you could have made huge money if you had bought at the right time, if you had held it on for the right duration if you had exited in time. So even if you are a very if you're new to technicals, you don't know too much about it, or you don't read charts too well, you could still see that the stock probably topped out around 325, 330, started coming down, lower bottoms, lower peaks. The structure changed very considerably, and this is the place where you should have exited. Now, if you couldn't exit here, I'm sure around here you'd be able to see this change in trend. And even if you exited at 160 and if you bought at 30 rupees, it's a 5-time return in how much time? In less than 8 years, which is tremendous for a long-term investor. So you should have exited here. Post that, there's nothing on the charts. The stock has been in a downtrend, but it is so widely bought into. Everyone's got it now. It is because it seems like a great stock to own. It's beaten down. It's come off, and a lot of people think that because the stock has gone down, there's not much to lose, and that's the reason why people buy into the stock. A lot of people have bought it because of dividend expectations that the stock might announce a big dividend or government might divest stake and so on. So those are different reasons, but we are not looking at the markets from those reasons. We're looking at them from purely technical standpoint. So this is the third major challenge for a trader. First thing is that you pick your stock. Second thing is that you look at the Nifty, then you enter at the right time, and then of course the exit, which is the fourth most important decision that a trader needs to make. Now, most people do the exact opposite. They enter when they should be exiting, and they exit when they should be entering. So if you were to reverse that, you would see that a lot of money would be made. So the whole purpose of this exercise is to identify the key places where you should exit, and it is absolutely critical. In the long run, you would find that exiting slightly late doesn't really hurt. Entering slightly late doesn't really hurt too much. So rather than obsessing too much about getting your timing accurately right, of course, that is what every technical analyst hopes to do. And we've got a lot of tools in our armory that help us exit and enter at the right point. But even if you don't have them, or that is too difficult for you, you could still be okay. It's okay to to exit slightly lower than the top. It's okay to buy slightly higher than the bottom. In fact, for most of the stocks that I bought and made most of my money in, for instance, let's go back to the chart for Honeywell Automation. Okay, so this here is the chart for Honeywell. Now, when I bought here at 2000 rupees, the stock at some point was about 500 rupees. So it had already gone up 4 times. There's a gentleman I know who bought it at 45 rupees. So I got in at 2000 rupees. Imagine a stock that was trading at 45. I got in at 2000. So one could say that this was a very, very late entry, which is absolutely fair. But at that point, when I bought it around 2000 rupees, there was this huge breakout. That was the right point in time to enter. So very, very important to enter at the right time. Don't worry about the absolute number of that price. It's immaterial whether it's 2500 or 3000 or 4500, doesn't really mean much. If you're buying for a major up move and for the long term, even if you get your timing slightly off, it is still okay. So you can enter something that was trading at 2600, at 2800. It doesn't make too much of a difference in the long run. Then once you bought into the stock, it's important to hold on to it, but it's not very right to hold on to it even after the trend has visibly deteriorated. So exiting at the right moment is absolutely critical, and that is what makes all the difference. For instance, um, let us talk about a stock that is very close to my heart. And although I sold this off long, long time ago, I have never held on to the stock. I didn't hold on to the stock as long as I should have. But there is this stock called Eicher Motors Limited. Now, this is a very popular stock now that it's part of F&O. People trade it all day long. But back in the day, in 2008 and 9, I had a client who had huge positions in Eicher Motors. The stock used to trade about 300 rupees, 2008-9, and he had these legacy shares. He had been holding on to it for a very long time. This is that part of the history, around 300 rupees. and he sold it off the moment it first broke above 300, thinking that this was too high a price. Again, the same logic that worked for uh, large number of investors in HUL. Exactly the same logic at work here. It's difficult to resist profits. You've been holding on to the stock for too long. The stock has gone up. Now you have a choice to exit. And that is where most people would exit. So he sold at 300, goes to 500 rupees and then to 800 rupees. Now, how do you buy something that you've sold at 300? It's very difficult. And then the stock runs away. It goes on to become a 30,000 rupee stock. So 300 rupee stock in 2008 and 9 becomes a 30,000 rupee stock in 2016. And this is how the markets are. Now, again, unpredictable. You can't predict what will be the extent of this rise. Nobody could predict it. Why does this happen? It's because there is institutional participation. Retail investors never can cause this kind of a rally in a stock. It is mostly the larger players who fill the void. Retail investors exit, institutions get in, and they drive prices up one way. It went to 35,000. Nobody had those shares. Nobody could participate while it was going up. It seemed so expensive. आपको लगता है 30,000 रुपए का एक शेयर कौन खरीदेगा? लेकिन the same argument you could have given it at 5,000. It was very expensive when it was 5,000. It was very expensive when it was at 10,000. And then it went to 30,000 rupees a share. And then the charts deteriorated. You should have exited at that point. So very important to exit at the right time. People are still holding on to their Eicher Motors, and that is very critical that you have to enter and exit at the right time. Now, there is this big question of how do you choose stocks? It's because there are too many of them. There are over, okay, so we have a question. Okay. See, Mr. Kaliappan has got a question. He says, what are the specific signals for exiting? See, there are multiple ways in which you can do it. One of the simple, I'm trying to keep it simple in this webinar, is because this is early days for you, I would imagine. And it's not a great idea to complicate your entry and exit signals very early on, is because I have realized that a lot of people bring in complexity for the sake of complexity. They don't really need it. So don't complicate your system until and unless there is some benefit that you're getting out of it. So I try and to keep my own ideas very simple, and we're trying to keep it very simple here as well. So even if you used very basic technicals, something like lower bottom formation that you mentioned, that's basic pure Dow theory. And there are investors, there are very significant large global investors who are using this very simple idea for their investments. Of course, they have access to all the fancy ideas, but they like to keep it simple. And I think that that is the best approach, even for what RSI would do best for the stock, and we tend to get mired in that. So it is important to keep your focus, look at the bigger picture. Even if your ideas are simple, you would still get the same return. So that is very important.
Okay, just checking. Couple of guys are saying audio lost. Just checking. Can you hear us? Can you please confirm? Okay, thanks. So guys, okay, thanks. Thank you. So I'll keep on coming in the middle and check with the audio loss thing.
Okay.
So I think you need to repeat the
So I'll repeat what we were just discussing, is that, see, it's important to keep your ideas simple. Simplicity is one of the most powerful tools for a trader. And I know people, I keep looking at, a lot of my students use various ideas. And they, of course, now because of the internet, everybody's got a lot of information at the tap of the mouse. So they have a lot of information, a lot of new ideas will come to you. There are concepts like Gann analysis, and there is this huge fascination with wave theory. Then there's this concept of Hikenashi and Renko charts and so on, and there are multiple indicators. You'd be surprised to know that there are over 1,500 indicators. Plus, there are more in the works. Uh, there is a website, I forget the name, which runs a challenge that you can come up with your own indicator, and it keeps giving you, you can actually submit your indicator. So there are hundreds of thousands of indicators, variations of the same theme, and so on. So my own sense is that it doesn't really help. It will complicate, it will completely cloud your judgment. You have to identify what is the indicator bringing to the table. If the indicator is helping you make decisions better, it's only then that you must have it. If it's not actually helping you do much, and you're coming to the same conclusion even without the indicator, you don't actually need it. So one thing that you must do, I saw a trader screen very recently who has 200 different indicators placed on the same screen. So imagine the clutter he's got. Now, I asked him, why do you have this line on your screen? And the typical answer I get is that वो ऐसे ही रखा हुआ है. I just have it because पहले कभी देखा था. So देखिए, that is not something that will work. You will have to be very professional about your investing. Keep it simple, keep very simple ideas, and then you'd find you'd get much better results. So coming back to the question on specifics, it is important that you discover your own specific ideas. Trading has got a problem that you can't really copy ideas. You have to start with a basic idea, and then you have to build upon it. It's because it's only then that you'll be able to build the conviction to trade on it effectively. It has to be your own concept. I can, of course, give you hundreds of different systems, very elaborate systems, which will actually trigger an entry and exit close to the most optimum place to enter and exit. But even with those systems, you may not be able to make money, because the biggest trick here is that even if you got this signal at the right moment, even if you got the signal to buy Eicher Motors at 315, the real challenge would be, what will make the most difference is that whether or not you were able to hold on to that stock all through this period, and whether you manage to hold on to it all the way till 30,000. Now, this will require Herculean courage to be able to sustain that kind of profits for that long. Most investors, most traders I know, would have exited on some premise or the other somewhere during this journey. It's because it's so tough to actually hold on to something for that long. So it's very critical that you have your systems in place. Very simple systems work very effectively. So 4 points here. We started out with identifying the timing correctly. Second thing is getting the Nifty right. Third is exiting. Now, there are a lot of different aspects that go into exiting. You have to go by your chart more than anything else, and that is very critical. Oftentimes, you'd find that even for the chart for the Nifty, if we can go back to the chart for the Nifty, you'd find that it continues to form higher bottoms. There's a lot of uncertainty, negativity right now. This is the monthly chart for the Nifty. And you'd find that the Nifty has come down to 10,900. But remember, this is just the 7th of this month. There's a monthly close to wait for. And if the market sustain above 11,000 broadly through the month, you still have a series of higher bottoms on the chart. So nothing material has changed for the markets, although we've seen this big drop, and that has caused a lot of worries, and people are really scared. But the trend continues to be intact. Now, you have to live through situations like this in real life, when there is a lot of panic all around, everybody's selling off, and that's when you start to wonder what you should do. A lot of people just get carried away by that panic and make hasty decisions with their investments, which is something that you should stay away from. So go by your chart. Now, monthly charts, if you're looking at monthly charts, it's important to look at them only once a month, and that is towards the end of the month. And don't even bother with them during the month, is because this will create unnecessary anxiety that you can't do much about. So if you're a monthly investor, somebody who's trading for, let's say, 1 year plus horizon, it is recommended that you trade on the monthly chart, where each candle that you see on the chart is for a month, and the minimum holding time is about a year. Maximum can be several years. So if that is your idea, you should look at monthly charts, and don't bother with daily charts and short-term charts if you are into that idea. So one of the things that you need to focus on is identifying the trend correctly. Once you've entered the trend, you must ride it all the way through. The question that we keep getting is that, of course, we bought into a stock, it went up, and then some news suddenly came out of the blue and completely changed that stock. Now, this has happened to a lot of stocks, and this can happen to even the best of traders. Sometimes I remember I had a stock called Apollo Tires that got into that decided to acquire a company called uh, Cooper Tires. That was an American company that Apollo Tires once decided to buy. And because of that acquisition, the stock started going down. Okay. Okay. So what happened was that the stock suddenly corrected. Now I had this stock because it was outperforming the Nifty. It was doing better than the Nifty, and I think it was 2012 or something. And the stock suddenly collapsed. Now, what do you do then? Or what do you do in a situation where the stock is doing well, it's running away, and you're holding on to the stock, and suddenly its complexion changes because of a news? Now, see, there is nothing much that you could do about it. A lot of people ask me that what happens when suddenly news comes out. For instance, look at Yes Bank. Now, Yes Bank is a stock that we all keep talking about. This is a stock that everybody talks about at the moment. So let us look at the chart. Now, if you look at this, the chart for the for Yes Bank. Now, if you bought at the right time, the right place to have entered the stock was somewhere close to about, let's say, 2011. 2011, the stock used to trade at about 40 rupees, and then it went to 400 rupees in 2018. And during this period, if you look at the chart through this period, the stock was forming higher bottoms all through. And then suddenly there was this big disastrous news, and this is where the collapse happened. The stock in a single month dropped very substantially, almost 40% drop in a single month, and it started trading at around 170. Now the thing is, at this point, at this particular month, this is what month is this? Let us see. This is okay. This is March 2000. No, this is September 2018, right? So in September 2018, the stock suddenly collapsed. Now the thing here is that this is the place where you should have exited. If you had bought at 40, exiting at 160 would not have hurt you too much. Look at when you bought. You bought in 2011-12. This is 2018. 6 years later, your money has gone from 40 rupees to 160. That's 4 times. Of course, it went up to 10 times at one point in time. If you had exited just a month back, you would have probably got 9 times on your investment. But even if you exit 1 month later at 160 rupees after this big collapse, after you'd waited for the entire month to go by, and you had exited at this end of the month, you still would have got 4 times return on your capital in less than 6 years. So that is not bad at all. That's tremendous return on money, and even for a stock like Yes Bank. But the thing here is, you should have exited here. You should have exited at 160. If you didn't exit at 160, there is absolutely no recourse left. Of course, the stock went up on a pullback, but that's very hard to predict. The thing here is that if your rules tell you to exit, you must exit, even if you're exiting way down below from the high that you've seen. Also, what to do about the news? See, news is something that we can't do much about. You have to learn to live with it. It's because we have no control over it. You can't really decide which stock will go bust next. You don't really know that until it actually happens. But in technical analysis, there's always an exit. If you've entered at the right time, you know when to exit. Once in a while, you'd buy a stock, it goes up some, and then suddenly collapses right on your face and leaves you with a small loss. That happens all the time. That's the risk that you're running to generate the returns that we're trying to capture. The returns that typically investors get in trading or investing can be several times the return that you'd get in a bank FD. So if that is the kind of return that we're all trying to get, how do we even expect for this to be absolutely devoid of risk. There will be risk, and that risk will show up in different forms at different points in time. But the idea is to strategize so that your risk doesn't wipe you out, and that an individual stock that doesn't go according to plan doesn't leave you with too much of a setback. So that is the part on risk management, which is absolutely critical. So there are these 4 points that fit together very well to make an investment proposition, and that is what all of you should try and do. Uh, okay, so Ashok has got a question. He says, is finding range bound stocks on monthly? No, see, Ashok, this is just one of the ways to do it. There can be better.
Read the question.
So the question that Ashok has is that so finding range bound stocks on monthly charts is the key technical criteria for picking stocks to invest on breakout. This is what I have been trying to tell you so far, but this is only for starters. There is more to it, and there can be multiple ways to do it. But this is one very powerful idea. You could improve upon it. This is a very simplistic way to do it, but you can use indicators to actually identify stocks. There are multiple correlation models that you could use. So many ways in which this. It's very, very powerful.
Hi, Kunal. Can you just repeat the last line for us, please? Yeah.
Okay. See, I was trying to answer this question from Ashok, and his question was that should one only use monthly breakouts to make entries? So my thing is that, of course, this is one idea. There can be multiple ideas. There are many, many ideas, and I'm trying to keep it simple for all of you because you're just beginning. There is a great deal more to it. Stock selection is absolutely critical. And one of the ways is that you can identify a major breakout and then get into the stock. If you were to do that, even if you were to use something as simple as that, there is a lot of money to be made, even with an idea as simple. But you could, of course, try and use other ideas. There are too many. And whatever idea works for you is effective. So this is the answer to Ashok's question. And one thing that you must focus on is okay. So there is Devendra's got a question on RSI. RSI is good too. See, like I said, there are multiple RSI. Okay, Devendra's question is RSI best for monthly chart above 50? That means I think he means that every time RSI goes above 50, one should buy and exit when it goes below 50 or something. See, that is tactics. You can use various ideas. You can improve it, change it. RSI is a very powerful. It's like having different instruments plugged into a patient. So if you walk into a hospital, you'd find that doctors have got all these gadgets nowadays that they keep looking at to monitor a patient's health. So the point I was making is that there are multiple indicators. There are quite a few of them. And of course, this is beyond the scope of this webinar. But what you could do is that you could build strategies around those indicators. But the important thing is you have to get your first principles right. So indicators will help you understand the stock's movement better, its trajectory better. You can parse through the price movements, the noise much better if you had indicators. But if you think there's some magic indicator out there, which is very simple, and all you have to do is to wait for one line to cross the other, and you will get the perfect entry using that indicator, then I'm sorry to tell you, but it doesn't work like that. It's way too complicated. So there is a lot of complexity. If this can make you a lot of money, don't for a moment imagine that this can be simple. This has to be very, very difficult. Otherwise, everybody would be doing it. So this is difficult, but with a little bit of planning, with a little bit of thought. One thing that I've noticed is that too many people into the markets without any plan at all. So people just wade into the market and they start trading, they start putting their money into whatever stock everybody is talking about. And then they tend to lose money. Now, a lot of people have got investments in, let's say, government banks. PSU banks is one of the biggest wealth destroyers of recent times. So let's pull up a chart for, let's say, something like an PNB. Okay. So this is the chart for PNB, and as you can see, the stock is breaking major levels. Just like you were talking about stocks that were making major levels on the upside. This is a stock that has broken a very critical level on the downside. So this is exactly the reverse of what we saw happening to all of these stocks that have run up. This is a stock that is collapsing. So important thing is that you have to be on the right side of the market. You can't blame the market for not getting you the return. You have to consciously work on a plan. How much money will you deploy? How long can you hold on to that stock? How will you pick stocks? And how will you exit them when you need to? So these are questions that a trader needs to find definitive answers to. And it's only then that you'd be able to develop a strategy. Okay, so there is another question we have from Amit. He says that first part, how to select stocks. Now, that's a good question. And that, of course, can take a lot of time for you to fully understand that. But what I'll try and tell you is that a couple of key points to focus is that one thing is that you should avoid stocks which are very volatile as a rule. Generally, stocks which are very volatile tend to be very difficult to play with. So sticks to stocks which are less volatile. Second thing is choose stocks where fundamentally or the quality of the management is not a question, but where it is above reproach, as we say. So stocks which very, very good management, and that is not too difficult to assert. A lot of people ask me, how would we know that the stock has got a good management or not? Say all you have to do is to just delve deeper into yourself, think about it for a moment, just think about it, and you would know that this is a stock, the promoter is good. For instance, if I were to mention, let's say the House of Tata, there are too many companies with Tata are running, there's too many listed companies. And if even somebody who follows the market very, doesn't follow it too regularly would know that that is a very good management. So all of us have that instinct that this is a company that you could bet on, this is a company that one should avoid. If you've got the slightest hint of something or about the company's management, you should stay away. That's one thing that you could do. It's not too difficult. A lot of people have that instinct. If you think you don't have it, it's still not a problem. All you have to do is to bet on stocks that you've heard of, stocks that are good, that is, the companies have been there for a very long time, businesses that you know exist. So very often people buy into stocks that they don't really know much about. Some time ago, I remember I saw the chart for a stock called Manpasand Beverages. Now, somebody suggested this was a tremendous company and that consumers goods companies are going to do very, very well. And he said that this is a company that has got a very good product. It's very popular. It's a substitute for fruity, a very favorite drink. Now, I saw the chart, and this was, I think, 2017. So in 2017, the stock was running away. A lot of mutual funds and PMS schemes had bought into the stock. But simply, I didn't really understand it too well. I didn't know the promoter. I didn't know the pedigree. I was not very confident of, and I didn't have enough data to go by because the stock got listed in 2015. So we didn't have much on the charts. So now the charts are not helping. And number two, I'm not very sure about the company's management. So if those two things don't add up, there is absolutely no rationale for buying the stock. A lot of people bought into the stock. 400 rupee stock is now 7 rupees. So a lot of money got lost. The idea here is that you have to be very, very conscious about stock, the quality of the management that you're betting on. I know this is slightly subjective, but with a little bit of time in the markets, you will develop the sense and you will know what stocks are good, what stocks are not so good. And if there is a management that you're not very sure about, just try and sidestep it. Don't buy into it. Worst is that you would lose an opportunity. And if you continue to be in the markets, you will get a lot of opportunities. One thing is, I have this huge fetish for MNC stocks, and I've been acquiring them for a long time. You mentioned Honeywell Automation. I've got 3M India in my portfolio, another very powerful stock. And as we see, coronavirus has caused a lot of stocks to go down. This is a stock that has actually gone up because of the coronavirus, because most of the masks people are wearing these days are from this company. Let's look at the chart. So this is 3M India. Look at what a wonderful chart it's got. And I bought it around 3,000 rupees, now trading at 22,500. And I'm sure all of you can see the rationale and why the stock has been doing well. And the thing here is that you don't have to worry about its fundamentals. It's because it's got global promoter. The company is an MNC stock, very, very good fundamentals, corporate governance. So one thing that you could do is focus on stocks where you're absolutely sure about corporate governance, even if despite all your safeguards, you still are sometimes you end up with a stock which is not of such great corporate governance. It is still okay for a chartist. It's because you always can exit when you have to. So when there is a breakdown on the charts, you can exit, of course. Of course, you might lose some bit of money from the top, but that's okay. That's still tremendous return. All of us are looking for about 25. Now, when I ask this question, to let's say I ask this question to a room full of traders here, all of you can answer here. What kind of return do you think markets can generate? What kind of returns are you eyeing? What kind of returns would make you happy? 20%, 25, 30, 100%? What returns do you think are realistically gettable? Okay, 13, 20, 25, 12 to 15, 25, 25, wonderful. Okay, so all of you have very low expectations actually. It's because say 15, 20. Now, do you know what the return for the index is? What kind of return has the market been able to deliver in the last few years? Let's say in a 10-year period, in 2008, markets were 6,000. That was in 2008. At the top, it was 6,000 in January 2008. And in 2020, we know it's at 12,000. So it's doubled. Now it's, of course, come down 1,000 points. So it's doubled in the last 9 years. So important thing here is if the markets is giving you 11 and 11.5% return, and you're worrying about 12 to 15, there are quite a few here who say that 12 to 15% return is what they're looking at. I would suggest that the best thing to do is to buy the Nifty. What can be safer than the Nifty if you're looking for just 12 to 15% return? But if you're looking for returns higher than that, that's when you need to get into stocks. Very often people don't have any comprehension of what kind of returns actually are they looking for. So we very often say very modestly that this is the return that will make us happy. But 12 to 15 is very boring. 12 to 15 is very easy to get. All you have to do is to buy the index and wait on it. It's 25, 30, 35, and 40% return. That is where you need to focus on charts and find these multi-baggers and these winners. So the important thing is if you're getting 30, 35% return on markets, it can't be without risk. There will have to be some bit of risk attached to it. And therefore, one should understand the risk well. You have to diversify across charts. You have to understand if you're making 30% on a stock, if it runs up for 2 years, gives you a 60-65% expansion from where you bought, and then it drops 30-20% on some day because of some news, it doesn't hurt you too much. It's because you bought at the right time, you already got 30% on it, so it doesn't hurt you. So the idea here is that you have to buy at the right time, which is very, very important. Okay, so there is another question we have from Rishikesh, and he says that what time frame we need to look at to find such. See, monthly charts is what you should look at, and you must have some history to go by. Ideally, you should have about 7-8 years worth of history. That is about 100 data points on your chart. If you don't have it, it's still okay, but you can't have less than, you can't go on a monthly chart with just 2 years worth of data. So you must have sufficient data so that you can construct a chart correctly, and so that you know and you can extrapolate based on what you've got, what might happen in the future. Okay.
So I'll just narrate this question which Omkar has. It's a big question, so let me just ask this question to you. I know you may not wish to speak on this, but what I think is one can identify stock, but to judge people management on top, For example, Gitanjali, DHFL, PC Chandra, PC Jewelers, above all, Yes Bank. But because we get to know what has happened when everything is vanished by these people, because rating agencies, brokerage houses start shouting only when management has already cheated.
Okay, say a very pertinent question, Omkar. I can sense your outrage in this question. But see, the trouble is that there's nothing much we can do. As market participants, you have only two options. If you think the markets is rigged and that it's all manipulated, then you could stay out. Or the other thing to do is that you have to make money off the same market. All markets in the world have got some elements which create uncertainty, which create all of these scams have happened. We've had more than our fair share of scams in the past. In fact, the frequency of those scams has actually greatly reduced now. So, although you have a point, and people have lost a lot of money on stocks like Gitanjali, DHFL, all of the stocks that you mentioned, but the thing is, you have to have a strategy to deal with it. This could happen to anyone. Yes Bank was a perfectly good stock. All of us at some point had investments in Yes Bank. We bought into it, we exited, and so on. So there was nothing wrong with it. The trouble is, it could happen to the best of companies. We've seen what happened to Tata Motors, for instance. The stock has come down so significantly from the top. It's a great company. BHEL is a tremendous company. It's at the forefront of the country's economy. So you can't really say that BHEL is a bad company. Or PNB, for that matter, is the second largest PSU bank in the country. So you can't say that it's not a great bank. All of that is true. But even with those stocks, you could destroy a lot of wealth. That point is that you could blame the rating agencies, you could blame brokerage houses, media channels, even analysts like myself, uh, for not highlighting the risks earlier. But there's not too many people who actually worry about the risks while it's going on. It is important to do your own research. The whole idea of this webinar, the whole idea of me coming all the way from Delhi to connect with you, is to try and empower you. That has been my life's mission, is to try and empower you to make those judgments yourself, because nobody, don't depend on anyone, everybody is after their own self-interest. You have to focus on what's good for you, and the only way to do that is to know. And knowledge has got great power. The more knowledge you have, the more better your analysis will be, and more effectively you will be able to save yourself from disasters. But still, there will be disasters, and you will be caught on the wrong side of the disaster every once in a while, but it's perfectly okay. In the long run, doesn't mean much. I remember Warren Buffett lost a lot of money on a company. He bought a shoe company, if I remember correctly, and I forget the name completely, but he bought a $400 million worth of stock, and that Dexter Shoes, if I remember correctly, the stock was called Dexter Shoes. He bought it in '93 for $400 million, and the company went bust. So if that can happen to Warren Buffett, somebody we say, somebody who all believe is one of the greatest investors of all times, then of course you too will lose money once in a while. But the important thing is position sizing. You have to be right. Warren Buffett didn't lose his entire capital on it. It was very small part of his total portfolio. So even if one of the stocks don't do well or goes against you, you should still be okay, and you should know when to exit.
Right. So, Kunal, I think I'm the moderator for today's webinar. So I will take the liberty to ask you a few add-on additional questions,
I know.
apart from the questions which is all of them are asking, and I'm going to help you decode their questions also.
Great.
So my question is, this chart 3M, the stock which you are owning right now, we understand your entry strategy. When will you exit this stock? Looking at this chart.
See, I will exit when it starts to form lower bottoms. That's the idea here. See, of course, I might exit for some other reasons.
Okay.
This is not the sole reason why I bought into the stock, and my exit could, of course, be based on some other parameters. But for an average trader, if you are just looking at this chart and you're looking at it for the first time, all you have to do is to look at this chart from first principles and think about where do you think the chart will change course. It hasn't changed course as yet. As you can very clearly see, the stock is continuously making higher bottoms, so there's no reason for you to exit. The moment it starts to form lower bottoms, that's when you should think about exiting. And that might not happen now. It might happen 2 years down the line, a year down, who knows? So if you think, a lot of people ask me to put a target on it, it's impossible. I don't really know how far it can go before it turns course.
Right, right. So let's take an example of a stock which has, as you mentioned, the name of this stock. So this stock,
All right.
which had some business,
Absolutely.
but the business is not doing good. A lot of people actually bought this stock on the way down from
All right.
550 to 350.
Again, see that same sense of see, the thing is, a lot of people believe it's a great company. It's a tremendous company. Tata Motors is a decades old company. We know it's great, and the management also is wonderful. But the trouble is, uh, we don't know how far it can go. When it changes course, no matter how good the business, you still have to exit. That's very, very critical. And the moment it changed course, it was important to exit.
So when was that?
See, if you look at this chart very clearly, it turned course around 500 rupees for the first time. That's when it stopped forming higher bottom. This was around here. So slightly later. So once that happened, you know that the stock has turned course. This is when, if you were a trader, if I had this position, I probably would have exited. I didn't have Tata Motors and I've never held it in my portfolio. But if I did have it, I would have exited here. If you didn't exit then because you couldn't see it coming, or you got late, or you didn't see it because you needed more confirmation, or it was a tremendous company, it again gave you a chance to exit at around 270, 280. Again, if you had bought at the right time, 280 was not a bad price to exit. But if you bought at 500 rupees, then 280 is a horrible price to exit. So it's about the right entry point. So if you entered at the right moment, you exit at 250, it's still not bad a deal. And if you had exited at 250, it's half that price now. People are still buying. People bought at 250, they bought at 150, they're buying at 115, but the stock continues to go down. So that's the idea.
Okay, so we have a question from Deva, Mr. Khalid Pan. You spoke about Eicher Motors. Can you please comment on its current view? Is it a good time to enter or is it further following? I think that's a classic question all of you must be asking. I mean, you are quite used to answering these questions in zero.
See, on Eicher Motors, see, I think it's changed direction, and that happened when we marked it. That is around 2018. The stock went into a downtrend. It's continuing in that downtrend. There's absolutely no change in that trend, and there's no reason for you to buy this for the long term just yet. Now, who knows? The stock might start rallying from here, and if it breaks out again, gives you an opportunity to re-enter, then we'd completely change our view. But as of this moment, at this point in time, there is no reason for you to enter. There are better stocks available that are breaking out, that are in an uptrend. So focus on stocks which have got a very clearly defined uptrend, and stay away from stocks where the trend is suspect.
Okay. So Amit has a question: how to exit a stock which does not have long chart history like IRCTC or Bandhan Bank?
See, there's not much you can do about those stocks, Amit, is because we don't have history, and technical analysts go by what they see in the past. So for a stock like Bandhan Bank, which has only got a month worth of history, or maybe a few months of history, you can't really use this history to trade. So one should stay away. There are enough choices apart from these recent listings. We have 6,000 stocks, 120 F&O stocks. So you have more choice than anywhere else in the world except for the US. So in India, we are not short of stocks.
Right. Okay, so Kiran, your question is to me regarding the scans. I'll talk to you about it later. Just keep you posted. Uh, how to screen for identifying large trends? Is there any screen or any method?
See, what I suggest is that if you're tracking a limited amount of stocks,
Yeah.
if you're tracking the entire basket, then it's tough. You need some automation. But if you're tracking a few stocks, that is, let's say you're tracking about 150, 200 stocks, you could well do it manually. So you don't really need too many screeners. But of course, you can build a screener. You can look at various fundamental concepts. You can also use some technical concepts to build basic screeners that will help you sort through that huge list. You could do that. Otherwise, you could look for a list like the S&P 500, for instance, S&P Nifty 500. That's a list of about 500 top stocks. And what it does is it helps you not get into the very under researched and low quality stocks. So that's a way to actually get around that problem.
So you suggest that do your chart trading every day for the limited number of stocks and figure out the trend change?
That's a much better way to do it. You have to be regular in your analysis. So you can't just look at the chart once and then forget about it and then look at it 3 months later and see. And by the time when you go back to that chart 3 months later, the stock would probably already have run up. So you have to be consistent. So develop a focus list, which could be 50 stocks if you don't get the time. Even 50 stocks are is too big a selection.
Okay.
So 50, 100, whatever you like, and then stick to that same list. Keep going on that list over and over, and you'll find good trades.
Okay. Amit Saha has a question: how to guess or find stop loss?
You can, of course, there are multiple ways to do it. There are a lot of technical indicators. There are moving averages that can help you identify stop losses. There's a thing called ATR, average true range, which can help you identify or calibrate your stop loss. But even if you place stop losses on, but you have to be consistent. Whatever logic you use has to be consistent. A lot of people have problems with stop losses because their general complaint is that the stock comes down, hits their stop loss, and then goes back up again. It's because you didn't place it correctly. So you have to be right about where you place your stop loss. There can be technical ways to do it. Alternatively, you could use the structure of the chart to identify the right place to put a stop loss, and that can be very done quite easily.
Okay, you want to take an example, or you want to
Sure,
take a stock?
of course. Let's say if you're looking at the chart, let's look at a very good chart. This is the chart for Nestle India.
Okay.
This is again a multinational stock that has done tremendously well.
Sorry.
Nestle is this very favored FMCG stock, NEST. This is Nestle. Now, if I was to look at this chart, now again, I'm sure you'd be able to spot the trend. It's got a huge uptrend. The stock has run up. This is a perennial business. Products are tremendous. We all know Cerelac and all of these wonderful brand names like Maggi and so many other stocks, KitKat, so many other brands are part of this company. So this is a company that you can rely on. You don't really have to worry too much about the corporate governance side of this business. Now, the idea is whenever it gives you an opportunity, you should have bought. That opportunity came in at various times. Now, if you look at this chart, the last major bottom that got formed was around 10,000. So ideally, your stop losses should be there. Now, you would say that that's a whole 40% or maybe 40% or 35% below the current market price. There's too much. So of course you can recalibrate. There are ways to do it. But if you go by first principles Dow theory, that's where your stop loss should be.
Okay. Okay, let me just. Can I select stock on the basis of weekly chart? That's Rakesh asking.
Yes, of course. If your time frame is short duration, that is, this is for about a year or more.
Okay.
If you are in it for the next 3 months to a year, you could use the weekly charts to do the same thing. So works just as well with weekly charts.
So weekly chart, can I enter and keep the stock forever?
Or you could, if the trend continues, that is.
Okay.
So if the chart is supportive, you could buy and hold for more than a year. But typical time frame, if you're using the weekly, should be between 3 months to a year.
Oh, okay. So if you look at monthly, it could be
More than
for
a
lifetime, kind of like 7 to 8 years.
Right.
Weekly is 2 3. Great. How to know which stocks are volatile?
See, although there are ways to do that, is again, there are indicators which help you ascertain or measure a stock's volatility. One of those indicators is average true range. So you can ascertain the stock's volatility. But if you're not using, if you don't want to get too technical, general stocks that you know have seen a lot of ups and downs over the years are stocks that are best avoided. Stocks which are always in the news that you hear too much about are best avoided. In fact, I am of the view that you are better off if you stay away from F&O stocks. F&O stocks generally tend to be more volatile as opposed to non-F&O stocks. So in fact, most of the money that I've made have been in stocks that are not part of the F&O. So you could also follow that strategy to some extent, although it doesn't mean that F&O stocks haven't done well. HUL is an F&O stock, so is Nestle, and both of those stocks figure in my portfolio. But despite that, you could, if you stick to stocks which are not part of the F&O, you can cut down on the volatility of it.
Right. I mean, just a point that in non-F&O stocks, you can actually, people can't go short.
Right.
So if you see, if you have a long bias, which is biasness of all the investors,
Right.
then there's a very less chance of any big short cartel
That's
to
true
come
too.
and beat that
That
stock.
is true too. Plus, see, a lot of other factors start to play on a stock the moment it's part of the F&O.
Right.
And that is the option trading happens, and then there are reasons for the stock to not to go up and to go up. So it's best to stay away from stocks which are part of F&O
Right.
from investment perspective.
Okay. So Amit has a question, sir. After chart form is very, I guess he said easy to analyze,
No.
but on the present current moment
Oh,
is very difficult
you
to
are
analyze.
absolutely right, Amit. I am completely with you. It is easier to look at the past, analyze it, talk about it. But that's the only thing we can do, is because, say, at the moment, these are not just stocks that we're talking about. These are real investments that I made at various points in time. So I bought Honeywell Automation at 2000, and I bought 3M India at 3000. I bought Nestle at around 6,500. So these are stocks that are real trades. When it was at 6,500, I didn't know it would be 16,000. That's exactly my point too. When you are looking into the future and you don't really know what's going to happen, it is the toughest to make decisions then. But then if you have some solid logic, you will be able to make those decisions more confidently. And when you make those decisions, there's always a chance that those decisions could backfire. The stock could suddenly go up and then come down again based on some news or some change in the scenario that happens all the time. So there's nothing much you can do about it except placing a stop loss and exiting.
Okay. So there is a whole bunch of questions on ITC. I guess it's time to open ITC chart. So show ITC chart is what Aditya is asking us to do. And his question is, Satya is asking, in this context, ITC is a good stock but not performing.
See, then again, the thing is, what do you think is a good stock? It's a very subjective statement. Is because we don't really know what's good. What's good is what performs. If it doesn't perform, it's not very good. It's a great company. We all know that. Everybody's got it. And it's a in fact, there was this time, I remember in 2008, 9, 10, I was very positive on the stock. And this is the time when it actually was using its cigarette earnings to create those brands, FMCG brands like Sunbeam and Annapurna, and they invested heavily in Pharma Devils and so on. So that was the time when I really liked the company. It's got a lot of land also, wonderful company. But the thing is, it doesn't really help us. If it's a great company, it has to perform. It has to form higher bottoms. It has to go up. If it's not going up, if it's going down, it's breaking levels, there is no rationale for us to enter. So we're completely committed to the charts. My opinion is just as good as yours. So we don't really know. I would still say ITC is a great stock, but the thing is, it must perform. That's the reason we buy stocks.
Okay, so for people who have entered at a lower level, with your theory, they should have exited
Of course,
at a higher level
around
because they were
275, 270.
right.
That's the place where you should have exited. There's no rationale for holding on to ITC post that. And post that, of course, the stock is corrected to 180. Now people are buying into it again, although it's a major support area. But charts don't really suggest that you should buy ITC. There are better plays available.
Okay. Devendra is saying, should we use last low of higher low for stop loss?
Last low of higher low. See, um, see, the idea here is that you have to go by, there can be a multiple ways in which you can place your stop loss. Like we discussed, you could place it on the structure of the chart. You could use an indicator. You can have a time-based exit. You can also place a stop loss based on a percentage amount of money that you're willing to lose. That is your risk-based stop loss. So there are too many ways in which you can do that. So my idea is not to restrict yourself and not to restrict you to one idea. But yes, you can place a stop loss at the past low. That's a fair way to do it. But it can be improved, yes.
Okay. Tata Motor came down with the market, but is it right time to enter now for long term?
Again, see, there's no real rationale with the markets. No, see, there's a mistake there. Tata Motors came down despite markets going up, so it's been underperforming the markets. Markets went up to 12,000, made a new high, but Tata Motors was going down, so it's underperforming. Look at the trajectory since 2017. It did not go down with the market. It went down even when the markets are going up, so it's underperforming. So that is one reason to why you should stay away. There's no reason to buy the stock. It might rally, of course, but we are not. You can't get all the rallies. You can't capture every move. You can only capture the moves which fit your criteria. So you have to be strict about what criteria you impose on your investments, and then look for stocks that meet that criteria.
Okay. So Amit Saha is asking, I think you are going to talk about position sizing. Can you provide some information about this?
See, it's a very powerful thing. You have to think about how much money you have. And one problem that most people face in long-term investing is that the money keeps changing. So you may have a lot of money now, but you may have some other, you may have less money in the future. Or you could have money, but you may incrementally keep getting more money as you save. So you have to develop a plan for your investment. Now, this is the X amount of money that I have right now, which I can invest right away. And this is how I will keep adding to that number. This is the money that I'll keep generating. And I will use that money to add to my existing corpus. So then you deploy, then you divide your money across stocks. So you have to develop a strategy for it. It's very important that you do that. And one of the biggest failings of most investors is that they have a very weak um, position sizing plan. They tend to go all in one stock that they have heard about or that they think will go up. Very often people buy a stock. Initially, they buy a reasonable quantity. If it starts to go against them, they buy some more, they keep averaging. This is exactly what they did with Tata Motors. As stock was going down, people averaged. And they first bought it around 400. It came down to 300, they bought more. It came down to 250, they bought some more, thinking that now, of course, the stock would start going up. Now it's at 100 rupees and you got 3 times as much quantity as you started with. So that is the problem. You can't really keep buying the same stock over and over again just because it's not going in your favor.
What is your view on Nifty for short term?
Short term, we all know there's too much news to deal with, and very hard to really say which way it's going to go. The trend at the moment is bearish. If you're a short-term trader, there is no reason for you to go long, except that you might think it's gone down too much. There can be a pullback, which is unpredictable. Can't really predict it. So that, of course, can happen any day. There can be a lot of positive news that might suddenly come in. Coronavirus fears might subside and so on. So we don't really know. We are not in the business of predicting the news. We are in the business of looking at the charts and making predictions based on the charts. So on the charts, the trend continues to be bearish in the short.
Okay. So I have a question from Sharad Chandak. In Bajaj Finance monthly chart, Feb candle is the trend reversal candle pattern, shooting star. Since stock is in the continuous uptrend, should it be bought in corrections?
Okay. Interesting question.
See, candlesticks is a completely different ball game. It's typically for swing trading, short-term trading. And the focus here, today's focus is on investing and catching the bigger trend. So candlesticks won't really help you with it. So let's keep that for some other time. We will discuss candlesticks in greater detail. It's a very powerful tool though, and can really help you identify short-term swings very effectively. But from today's perspective, the thing that we are focused on right now is longer-term investing, and therefore candlesticks is of little relevance. So leave that aside for now.
So if suppose we remove the candlestick part of this question, suppose looking at the chart of Bajaj Finance, the way it has come from the levels and it will is, so can we say that there is a reversal in the trend?
Not yet. I think the long-term trends are still intact. There's no change in that trend. It's just a correction, given that the stock has been, see, it's had even more serious, as you can see, if you go back in history, you'd find that stock has had similar or even longer corrections in the past. Some of these corrections lasted for several months, for 6, 8, 9 months. This time the correction has only been 2 months. So it's just a correction just yet. So we don't really know. Now, this correction could translate into a trend reversal at some point. But as of this moment, as of the moment that we are talking about, where the stock is trading at 4,200, there is no change in trend. The trend still remains intact.
Okay. So if someone has to enter, the person can make an attempt. If suppose someone makes an attempt to enter at this price, what would be the stop loss?
No, see, there is no reason to enter. All I'm saying is that the trend is intact. Now, where do you enter is again an entry point.
Yeah.
Entry point is something that is long, that happened in Bajaj Finance long time ago. If you go back in history, you'd find that this breakout happened. I say there was this huge breakout in 1900, if I remember correctly. This was after the results at 1900 or something. So that was the point where you should have entered. Now, if you didn't enter then, it's you can't enter now. You have to wait for the stock to consolidate meaningfully, then break out. So you may have lost the opportunity, but you will get more opportunities in the future. There's no real buy point here on this chart.
So I mean, I should not look at Bajaj Finance then in that case.
No, you should definitely look at it if you've got it, and you must hold on to it. But where to enter, that is something that you must focus on. And at the moment, you can't enter.
Okay. So you can't enter, but people who already have it, they should not exit because the uptrend is still continuing.
Right.
Okay. So Rahul is asking question. Kunal, please repeat the 120 shares. I didn't get it. Did you get the question?
120.
Rahul, you have to probably repeat the question, Rahul Sharma. Okay, I'll move forward. Okay, Atul is asking a question. Can 21-day exponential moving average, 50 moving average with RSI will be a good indicator?
Can be. So you have to try it out, and finding the right system is what takes a lot of time. See, if you find a system that works for you, that is to a very large extent the destination for a trader. And that is what we are all trying to achieve. So I don't think that you'll be able to get that system very easily. It will take you time. The intention here is to get you started, so that you start thinking in the right direction. That's the objective here. You can try different indicators and combinations of them, but like I told you, none of these indicators will work unless you get your principles in place. So the 4 things that I have mentioned today, try and get them right first, and then think about tactics.
Okay. So Ravi has been asking this question for a long time now, and I guess we have already answered, but if you can just repeat, how to know which stocks are volatile?
See, again, like I told you, a lot of stocks are volatile is because what is volatility? Volatility is erratic price behavior. The stock would go up one day and go down the next day. And each time it does that, it is a huge percentage of its price. So stock that is very volatile is where the risks go up, but a lot of money can also be made. So volatility is not necessarily a negative thing for a trader. So you have to decide, and how to measure volatility. There are indicators which help you do that, and you can use one of those indicators to a certain volatility. But my sense is, when the reason I said that you should try and avoid volatile stocks is that stocks which are always in news, there is a lot of government intervention in stock. For instance, pharma stocks, which often get these FDA notices. And because of these notices and FDA developments, these stocks tend to go down very sharply the moment there's an FDA inspection. So these are stocks that are vulnerable to that volatility. And as a result, you should be slightly wary of buying to those stocks. So you have to look at your stocks, look at its volatility map, how it's done in the recent past, and then decide whether the stock is volatile enough or not.
Okay. Abhinay is asking what key fundamental matrices you look at?
See, I don't look at fundamentals in that sense, is that we are not looking at fundamentals in a way that is easy to comprehend. We look at the qualitative side of fundamentals more than the quantitative. So I'm not focused on the return on capital employed and things like return on equity. We are focused on the quality of management, which is a more subjective, more vague, a more softer thing to analyze. So it's slightly tricky. But what you can focus on, like I told you early on, is to try and stay away from stocks that you are suspect about. That's the idea.
Okay. Rishikesh is asking question, at what price we should buy once the previous high is broken?
See, that price can vary for different stocks. You could get breakouts at different levels. I'm not.
Let's take an example of Nestle.
Right.
Say, suppose someone has decided to buy Nestle, but waiting for the right price to buy.
Right. So see, you should have bought around 5,000, 6,000 is where I bought. So that was the place where you got this breakout. So again, the price could vary. Sometimes you might get a breakout at a very high price. Sometimes you get it after it's corrected. So you might be able to buy at a lower rate. So breakout prices can change. Doesn't really make much of a difference. The moment you get a breakout, good buy. But then one thing to remember is that not all breakouts are tradable. Is because you get too many false breakouts. So if you just went by this logic alone, you may not really see as much success. The stocks that we are talking about here are all stocks that are part of my portfolio have done well. But then for each successful breakout, there could be 3 breakouts that do not actually work. So you have to be very, very selective in which breakouts you bet upon.
Okay. So coming back to this question, so in case of Nestle, how will I judge which breakout is a good breakout, or which price could be a breakout? Is this immediate high
No,
of 16,800 could be a breakout?
see, like I said at the start of this, that you have to first judge is what is the current uh, state of your stock. Is it consolidating? Is it going up, going down, or is it stalling? So if it's like in this case, it's going up. You can't buy a stock that's already gone up. It's too late now to get into Nestle.
Okay.
If you buy now, your stop losses would be very low. That is, you'd have to work with a probable decline of 20-30%, which is very difficult for most traders. So you can't really buy now because of the risk reward.
Okay. So, I mean, especially when we're talking about long-term investing,
Absolutely.
then this may not be the right price. This has to correct,
Absolutely.
consolidate, and then give a breakout.
Absolutely.
Then we will buy.
That's right.
So otherwise, I will probably miss the opportunity of if suppose Nestle tomorrow goes up to 50,000.
You could, but see, you missed that opportunity not now. You missed it when you first missed that breakout.
Okay.
So the idea is to buy at the right moment. Like we said, if you look at a Yes Bank, for instance, it went from 40 rupees to 400 rupees. There were opportunities. If you had bought at the right moment, you still could have got 4 times 400% return on your capital, even after a major collapse. But you have to buy at the right time. If you bought at 40, you were okay. But if you bought at 400, then you're in trouble.
No, so but if I bought at 200, I'm just discussing the topic with you. If suppose I got bought at 200, then I would have got opportunity to go up to 400.
Yeah, that's true.
So maybe 16,400 is that 200 of.
But the thing is, if you buy at 200, how would you enter it? How would you exit at 400? See, the thing is that, like it happened with Yes Bank, there's a single 1 month fall of 40%. So you buy at 200, stock suddenly collapses on a news, you lose 40%, you end up selling at a price much lower at which you bought. So you don't really know that. The idea is if you buy at the right place, you have enough safety net.
Okay.
So you have to protect yourself at every time so that you don't lose much money on a single trade that goes wrong. And some of your trades will go terribly wrong. You can't do much about them. That's part of the game. So a lot of stocks that I bought into that went up but didn't perform and started going down, there are too many of them.
Yeah, so it's actually one of the questions which Aditya is asking. Do you have any stocks which are giving you negative returns?
See, my idea is I don't really keep those stocks for too long.
Okay.
So if a stock starts to underperform, I tend to exit that.
So let's take an
But
example.
there are too many. For instance, I had at some point in time, there was a stock called Mirza International. That's a stock that I once had in my portfolio, MIRZ. It's a small company and it manufactures a red tape brand of shoes. And I bought it around here, 2017. The stock broke out and went up, and then it started underperforming, and I exited the stock. If I hadn't exited, I would have lost money on it. Look at the price today. It's at 50 rupees for a share. So wonderful company, good company. I liked the business then. I was confident the stock had broken out. But then, the thing is, you have to exit at the right time. If I was still holding the company, I would have lost a lot of money on it.
So will you buy again this company?
See, not necessarily. There might be better opportunities. The stock is in a downtrend. It has to go into an uptrend. If it goes into an uptrend, we could look at it. For instance, stocks like HEG and Graphite and so many other stocks, which which we never actually looked at, have done so well in the past. I don't own any of them, haven't even bought them. But if you look at the charts, these are stocks that were doing so well. They had these multi-year consolidation breakouts, and then they ran up to 4,000, 4,500 levels. Today it's at 900 levels. Most people couldn't participate in the rise as usual. They bought when it was going down.
So now most of the people are holding the stock while it was going down.
Absolutely.
They have it in their hand.
Absolutely, that happens all the time.
Yeah. So can you please tell us more about your trades that failed and the lessons learned?
Sure. They say there are a lot of stocks that didn't do well. For instance, one of the stocks that I had, I tend to forget my failures though, but some stocks, for instance, I had Tin Plate. Well, that's a stock that I had in my portfolio. Broke out, went up. Let's look at the chart. Again, broke out, went up, and then started coming down. That is when I exited. But this again has given me profits. This is a stock that I'd never thought would go up. It's because this is again a very boring kind of stock. It's a Tata Group company. That's the only reason one could have bought it. So the idea is that you have to select your stocks judiciously, stick to stocks that are doing well, and even the best performing stocks can become worst performing. So you can't be married to a stock. You have to exit it when it merits an exit. That's important.
Okay. Couple of more discussions. Bharti. I think this is one stock which is getting a lot of attention of retail investors right now.
See, a good stock. Bharti is broken out, no doubt. It's outperforming and has cleared this resistance at about 520, as we can see. Long-term consolidation breakout. So definitely one could look at the stock. The only trouble is that it's very widely owned, and there's a lot of news to deal with this because all of that is happening in the government, in the telecom sector, and that might really create a lot of volatility. So I would rather stay away from stocks, although it's got a really powerful breakout. But the stock is very volatile. Number one, plus it's part of the F&O, and therefore one should be slightly wary. Otherwise, it's a good stock.
Okay. Okay. Omar has a question. I want to ask about circuits. As one retail trader, can't buy or sell above or below that given level. But I have noticed in recent days, even if stock is not trading in F&O, the circuit is not there. Is it possible? No. So circuit filter has a rule which keeps on. So exchange can actually release the circuit filter even if the stock is in F&O, right? And they keep on changing the circuit filter.
No, the rules are very clear. In F&O, there are no circuits, but there's a cool off, and there's an intra-market cool off. So there are rules for it. You have to have enough number of unique IDs, and once those trades are made, then the circuit is released. So there is no circuit as such in F&O. As for cash stocks, there are circuit limits for each stock. So that is something that you have. So the one thing that you could do is that stay away from stocks which have got a lot of volatility, where you might get trapped and the stock might continue to go down. You won't get an exit opportunity.
Right. Pawan is asking a question. Can we discuss for 5 minutes on Elite Wave?
See, not something that I'm very sold on. Elite Wave is a very powerful idea. There are a lot of people who are using it. I, for one, do not use it for my own investments. So I'd rather that we stick to simpler ideas, which are easier for most people to follow.
Okay. Rahul Sharma is asking, PSU banks are suppressed for 6 months. When do you think they will rise?
Oh, I have no clue at all, Rahul. And that is because so much is happening, we all know. And that is why it's best to avoid bank stocks. And whenever they start outperforming, once they appear on our trading radar, we'll definitely make investments. I have nothing against PSU bank stocks, but as long as they don't perform, why would I put my money on them?
Okay. So basically, you only focus on performance of a stock vis-a-vis market.
That's
if it is outperforming the market, that's in uptrend, you will buy it. If it is underperforming the market, you will straight away sell it.
Absolutely.
Got it. How much maximum stock we should have in our portfolio?
There's no limit. Everyone's got their own ways of doing it. I once had 67 stocks in my portfolio. and now I've got a smaller number. So that can change with market conditions. You have to keep changing that number. So I don't have a strict rule for it, but it's best to have stocks which are manageable.
Okay, Aniket is asking best time frame for intraday. Any time frame of chart for
Intraday,
intraday?
it's
Yeah.
intraday, 10 minutes, 15 minutes, those are chart times you should focus on if you're trading intraday.
Devendra is asking, tell us one fine strategy which you are comfortable. One fine strategy which you are comfortable.
See, but there are strategy. If you from by strategy you mean a trading setup. So see, but there are a lot of setups. In fact, that is we have more setups than we have capital actually these days. So I would rather not give you another setup to deal with. The idea here is that you have to be conscious of the trend. So once you are in line with the trend, you can make your entry based on very simple concepts, which can be a moving average breakout, which can be a resistance breakout, and you could still make a lot of money. But you have to be right about the underlying direction in your stock.
Can you brief some good quality stocks which may rise or we can have an eye on it when market comes again in bull trend? Pawan Agarwal.
So many say there are quite a few stocks which are outperforming. I think their outperformance will continue. So quite a few stocks. There are stocks which are doing very, very well. For some reasons, see, it's not a good idea to actually recommend stocks here. That's not the idea of this webinar. And I don't want to give you that impression that these are stocks that I'd rather that you buy. So the idea is that you select your own stocks, but still look for stocks which have a very clear direction. That's important. So look for stocks which have got a direction, and like I told you, follow all 4 rules of stock selection, and then pick your stocks. And I think you should do it.
Okay, so we have just last 5 minutes, and I would request Kunal to just summarize. Uh, he has been very kind to have that patience for initial half an hour of disruption. I have disruption all in my mind these days. But anyways, so you have 5 minutes. If you can just summarize the key inputs for them.
See, I think long-term, the message from this webinar is that you should definitely look for long-term. I know, say, out of every 10 people who are interested in the market, 8 of them are interested in trading.
Yeah.
It's only a couple of people who are actually interested in capturing the bigger trends because it seems so boring. Why should one buy now and then wait for 5 years? See, but the thing is, even if you're a trader, you will have to look for an annual return. So if by a lot of trading you get 20-25% return on capital, and by investing you get that similar return without really having to trade too much or worrying too much about your trades, I think it's definitely any day better to just invest and wait. So investing has got its own merit. I am a trader myself, so I've got nothing against trading. I think it's a tremendous way to make money. But there is an element that some part of your capital should be devoted to investing. And to a large number of traders, I think they're best suited for investing more than trading. So you have to focus on investing. Another thing that we've been trying to bring home to you is that technical analysis can be a very powerful tool for investing. So if that is something that you've been able to appreciate in today's webinar, I think it will be a mission accomplished.
Awesome. Awesome. So, guys, Kunal has a flight to catch for Delhi. He was kind enough to come down to Calcutta and conduct this webinar right from here. My sincere apology for the initial half an hour hiccup. Technology has its own perils, so we have to live with it. And you all know that Elon Markets is very committed to give you value for your time and money which you have spent on us. So don't worry about anything. We are there with you to support at every stage of your trading or investing career. Now, Kunal is active on Twitter. His Twitter handle is @Kunal Saraugi. So you can actually post him, give him a reference of this webinar which you attended. And if you have any query, you can definitely ask him. And he is very kind enough to answer those queries. Thanks a lot, guys. He will have to make a move now. I hope you guys had some important learning from Kunal. I have been interacting with him since morning and I'm thoroughly enjoying all the interactions with him.
If you still have any questions unanswered, don't worry. You can email it to our support team. These guys are generally very, very efficient in making sure that the questions is answered by the relevant faculty, if not by me. Okay. So thank you. Have a great weekend. Happy Holi, guys. This is a great festival for all of us. Safe, be safe. Corona is all around, but play Holi for some time and enjoy your life. Happy Holi.
Thank you so much. Thank you so much, Vivek. Thank you so much, Elan, for having
All
me.
right, thank you, Mr. Bajaj and Kunal for being with us. I would like to thank you, both of you, for the great session. And Vivek, you really helped the user event to identify their query and the questions which they have put across. So I have few things just to say before I conclude this session. My dear listener, you will get a feedback form which will appear on your dashboard once the session is over from our side. Please do fill the feedback, because that's really help us to improve further. If you have any question which which we couldn't take, maybe because we missed out for any some reason, or if you have any question which comes post you see the recording of the webinar, you can put those questions to support@elandmarkets.com, and we will make sure that the answer we revert back with. All right, thank you everyone, and do not miss to attend the session of Mr. Bajaj next weekend. That would be really, really exciting, a webinar which we have planned on because of the demand of the users listener. So it's going to talk about the relative price on 14th of March. So stay tuned at Eland Markets website. Thank you so much, Vivek. Thank you, Kunal, for being with us. Thank you very much.